This video is on intraday market cycles and is meant for day traders. The key to successful day trading often is in understanding the context of the market. The market at any point in time can be in one of these four intraday phases: consolidation, expansion, retracement, or reversal. Every single day, very likely, you would find these four phases on your charts for every asset class, be it futures or forex. The first step is to learn to identify the phase a current asset class is in by looking at the charts. Subsequently, after significant trading experience, the next logical step would be to be in a position to start predicting various phases even before it occurs. But that's miles away, to be honest. Let's start building the foundation by taking one step at a time. This diagram depicts the price delivery framework involving the four phases that we just talked about. Often you would see price in consolidation before expanding in one direction. From expansion, price would generally retrace before expanding again. These cycles generally continue before the reversal happens after high or low of the day has been made. Reversal generally leads to direct expansion or first consolidation followed by expansion. These concepts are going to be much more clearer as I walk you through multiple examples. So let's zoom in on each of these phases. Consolidation is the easiest phase to recognize on a chart and often is start of a new trend or continuation of the old one. So what is consolidation? Consolidation is when price moves inside a clear trading range and shows no willingness to move higher or lower. What is its importance? When price consolidates, it indicates that both buy and sell orders are building up in a clearly defined range. Expect a new expansion in near term. What do we look for in price? The impulse swing in price away from the equilibrium price level that is found exactly at the halfway point of the consolidation range. So let's look at an example. This is a 5-minute intraday chart of NQ. If you look at the chart closely, you will see market consolidating depicted by the shaded rectangle area. You need to note three distinct attributes of a consolidation range: consolidation high, consolidation low, equilibrium or 50% of the range. And as you can see, the impulse swing away from the equilibrium, which is denoted by this big bearish engulfing candle, ended the consolidation phase. This impulse swing is nothing but expansion. So what is expansion? Expansion is when price moves quickly away from a level of equilibrium. And what is its importance? When price leaves an established range, it indicates a willingness on part of buyers or sellers to take control. Now, what do we look for in price? Big range candles when the price leaves the consolidation range. So let's look at an expansion example. This big bearish engulfing candle moving away from the equilibrium of the consolidation range indicates sellers taking control, leading to price expanding downwards. Now let's look at retracement. So what is retracement? Retracement is when price moves back temporarily inside the recently created price range. And what is its importance? So when price trades back to a recently created range, this indicates willingness for the market to offer fair value to participants before continuing on to the expansion. And what do we look for in price during retracements? Fair value gaps. I'm going to be covering fair value gaps in detail in next set of videos. For now, just notice how the price retraces back to offer fair value to market participants in this next example. If you look at this big bearish candle, the price delivery was offered only on sell side, leaving the market inefficient. The subsequent two green candles, which is depicted as in form of retracement here, push the price higher, also in the process offering buy side delivery, making the market more efficient for sellers to go short at this level. Now, this is a very unique trait of retracement that we would find very often, wherein the retracement happens for market to offer fair value for buyers or sellers at that point in time. We will look at another example of retracement in subsequent slides. Now let's look at reversal. What is reversal? Reversal is when price starts to move in opposite direction in relation to the current trend. Determining the point of reversal is many traders' Achilles heel. From my personal experience, I can say that one gets better with a lot of experience and journaling over a period of time in determining the actual point of reversal. Now, what is its importance? When price reverses direction, it indicates that the market has triggered multiple levels of stops in one direction and is poised for a significant move in the other direction. And what do we look for in price? The liquidity pools above old high or below old low. I'm going to be covering liquidity pools and related concepts in detail in next set of videos. For now, just understand that significant liquidity rests above old high and below old low. Let's look at an example. This is a 1 hour NQ chart, and as you can see, NQ made an all-time high on this particular date. Now, as I said earlier, just assume or understand that a lot of liquidity would be resting above its all-time high in form of buy stops. If you look at these price swings, finally what happened was the price was able to cross this all-time high, triggering all the buy stops here, with smart money pairing sell order with those buy stops. And as you can see, after triggering those stops, there was this big time reversal that happened. This is a classical example of reversal where the market would purge a liquidity on one side and then reverses very distinctively from that level. Now let's look at each of these 4 phases on a single chart in an example. This is a very recent NQ 15-minute chart that depicts or highlights all the 4 market cycle phases. So as we look at the very top, we see an area of consolidation. And after consolidation, we see an expansion where the price is very clearly and distinctively moving downwards, where sellers have the total control. Now, as we know, during any expansion cycle, it is often followed by a retracement. So as we see here, it's a retracement 1, followed by another expansion, retracement, and then final expansion. Now, at this point in time, right at the bottom of expansion 3, we have hit a point of reversal. So far, right from consolidation to this point in time, what we have seen is just the sell side of the curve, if you will. And now after that, the reversal happens, right? And then you see that the price made multiple swings in form of reversal and expansion. And since now we are on the buy side of the curve, the expansion is going to be on the buy side, whereas the retracement is always going to be on the sell side. Unlike when we were on the sell side of the curve, right? And now as you can see, after multiple retracement and expansion, the price was able to run the liquidity of the consolidation range before finally reversing. So in summary, let's go over the main concepts that we have learned in this video. Number 1, intraday markets run in cycles: consolidation, expansion, retracement, reversal. It is extremely important to understand the current market context before taking a trade. As per the market efficiency paradigm, smart money is always looking for 2 things. Number 1, to purge liquidity pools above old high in form of buy stops and below old low in form of sell stops. And number 2, areas of inefficient price action to offer fair value to the market participants. Now, I've only touched upon these concepts in this video. There will be a lot more in-depth review of these concepts in subsequent videos. Now, in terms of next steps, I would advise for each of you to look at futures, forex, whatever instrument you trade on a 5-minute, 15-minute chart, and try to identify each of the 4 phases that we have learned in this video. All right. I think this is the most important part, and this is where the maximum learning will happen, where you're going to look at the charts, train your eyes, and then start journaling them, right? Pay special attention to consolidation specifically, because 1, generally most of the trends start from consolidation, and number 2, it's the most easiest of the phases to identify on a chart. All right. So I wish you good luck with this exercise, and I will see you in the next video.